Okay, good morning to those that I've not greeted this morning. Thank you for attending our May session for Pulse. We have these sessions on a monthly basis, and in the next couple of months, we're going to have some of our other portfolio managers take the session. The purpose of the session is just quite simply to give us a bit of a background over what happened in the last month from a macro view. We highlight two stock picks, and then we give a bit of a look ahead for the month ahead. Of what we are monitoring and what is important to us as asset managers. So today we have Imtiaz Suliman. He's a director with Sentio Capital. He is also the head of Shariah Solutions, a chartered financial analyst by trade, and he will be taking us through this session. Thank you, Imtiaz, for your time. Guys, if there are any questions, pop them in the message box, and then we'll answer them at the end of the session. Thanks, Imti. All yours.
Thank you, Verlin, and good morning to everyone. Thanks for joining us this morning. As Verlin mentioned,
just unmute yourself quickly.
Oh, I should be unmuted. Hello, can you hear me?
Yes, we can hear you.
Ah, cool. Thank you. Good morning, everyone. Thanks for joining us. I'm going to take you through our portfolio, our thinking. We're going to focus a bit on the macro view as well. And this just will give you a better understanding and idea of how we're seeing the world currently and what are the key factors that we're looking at. And we'll look at some of the positions that have worked and some of the positions that haven't worked in the portfolio over the last month. So you'll get a nice overview both from a bottom-up perspective as well as from a macro view in terms of our thinking and positioning. There's been a lot of discussion and a lot of debate around US interest rates and how that's going to evolve over the year. What we've seen, over the last 4 months, year to date, is that there's been a dramatic shift in terms of the anticipated rate cuts out of the US Fed. If we just rewind to December 2023, the market was expecting 6 rate cuts for 2024 out of the Fed. And this rate view has been tempered quite significantly, with the market now only expecting less than 2 rate cuts for the year. So there's been a dramatic shift as we've seen inflation come down, but not as quickly as the Fed is expected. The Fed is still anchored around the 2% level in terms of inflation. And although inflation has come down, it's hovering around that 3% level. So, whilst it's still much lower than we've seen in the past, we're not yet at that 2% level. And the big challenge is going to be to get to that 2% level. Some of the measures that have come down are proving to be a bit sticky. If you look at wage inflation, that's been a bit sticky. If you look at oil prices, that started to tick up again, and that's having an impact on the overall inflationary numbers. So again, that's going to be the challenge out of the Fed. Just in terms of financial conditions, what caught everyone by surprise last year was that although interest rates were ratcheted up quite significantly in the US and around the world, the impact of that wasn't felt immediately. So, higher interest rates for the consumer in terms of borrowing levels, for companies in terms of their corporate borrowings, didn't filter through because of the fixed interest rate mechanism that's in the US and some of the other developed market countries. So although interest rates were ratcheted up, financial conditions have remained quite loose. And we've seen fiscal spend, which is effectively government spend, being quite robust. The US is running at a fiscal deficit of around 6%, which means that they're spending quite a bit in terms of keeping the economy going and stimulating the economy. We've seen the markets, hold up quite well around the world, and we've seen, housing prices also be quite robust. So that has an impact on the financial conditions, which has been quite loose, making monetary policy not as tight as one would have expected. In terms of global growth, the clear standout there is the US economy. The US economy has recovered quite significantly, and they're still growing at a pace that is above their long-term average growth. And that is important because if growth did slow down significantly, we would have seen interest rate cuts come through by now. But because of growth being quite sticky and robust, we haven't seen the interest rates out of the US come down quite significantly. It's important to mention that whilst the US is doing well, other parts of the globe haven't been as robust. So if you look at Europe, that's been patchy. We've seen economies like Germany come under pressure, especially on the manufacturing side, due to the pressures that we've seen out of China. And we've seen China also being slow to recover. Although China is growing at 5%, the growth hasn't been even across all sectors. So we've seen the property sector in China come under pressure. We've seen certain manufacturing segments in China come under pressure, but we've seen, the likes of technology, green energy, electric vehicles, those growing much faster. In terms of geopolitics, we've seen a multipolar world. The world is effectively shifting into different blocks. We've had the war in the Middle East. We've had Russia and Ukraine, since 2021, and that has continued. And this geopolitical scenario is something that's going to be quite significant. But although, we're monitoring that quite closely to see if it does spread to a bigger conflict around the world and in terms of the major powers of the economies. So this is a new chart that we're showing this time, and this gives you a nice idea of the macroeconomic factors that we monitor. And it will also give you an idea of how we use data at Sentio to augment our fundamental bottom-up analysis. Essentially, what you see there is a high-level heat map of the different macroeconomic trends. And this goes back all the way to 1999 to the present day. And effectively how you read this chart is the ones in red is negative and the ones in green are positive. So what this shows you is some of the factors that I've spoken about. Is it does show that inflation has come down, but it hasn't been quite significant as we've seen. Sorry, if I could just ask that you remain on mute, and we will have some time for questions at the end. So inflation has come down, but it's still, proving sticky for the last bit. Some of the items that I've spoken to in the previous slide are there, as you can see, economic growth, financial conditions. What's important to highlight is earnings. We've seen earnings that have bottomed, and we've seen earnings that have been quite stable. But the one thing to note here is that developed market valuations are starting to look a bit stretched. So we all know that the Magnificent Seven has done very well. That's essentially the technology sector out of the US. They've produced good set of earnings. They've been quite robust. Margins have expanded. And this is all in the back of the scramble towards data, artificial intelligence, machine learning, and those companies that produce either the chips or benefit from the AI theme have done particularly well. What we've seen now is a widening in terms of multiples relative to developed market equities and some of the emerging market equities. And in that emerging market equity bucket would fall, China would fall within that bucket. So, essentially, China has been under pressure because of policy uncertainty and the patchy growth that I've spoken about. Commodities have been quite weak. The PGM sector, the platinum group metal sector has been under pressure, but it's starting to recover. So we've seen a massive amounts of destocking in the PGM space. And we think, you could be close to the end of that destocking cycle, which would be positive for the likes of some of the platinum counters. Gold is something that we'll speak about, but that's been quite strong. And copper has also been quite strong. From a sentiment perspective, sentiment is bullish. And essentially, when sentiment is bullish, that's a bearish signal because, positioning is very bullish. There's a lots of money in equities, and equity allocation is at towards the high end. And then from a global risk perspective, that is low. So what we're seeing is, and from an overall trend, a recovery in earnings, a recovery in growth, and inflation starting to moderate. I'm going to focus on a few stocks in the portfolio. The one stock that's been a contributor to the portfolio is Goldfields. Gold has been a strong performer just in terms of the metal, and there's a variety of reasons why gold has been strong. There's a lot of speculation, but some of the fundamental drivers for the strong gold price has been buying by central banks. Central banks have been big buyers of gold over the last year, and that's been driven by a diversification out of just US assets into other hard assets such as gold, and gold has been a beneficiary of that trade. So Goldfields is one of the gold counters that we've held in the portfolio. We do hold the likes of Anglo Gold and Harmony as well, but it's been a strong contributor. And what we like about Goldfields is that it gives you a leverage exposure to the gold price. So you might like gold, but if you do think gold is going to do well and will continue to do well, by holding the underlying counters, such as Goldfields, that gives you a leverage exposure to a rising gold price. With a rising gold price, comes better margins, comes better cash flows, and you've seen very strong balance sheets out of the gold sector in particular. And that just insulates these companies further, should we have a drawdown in the gold price. So we've seen very good earnings growth come out of the likes of Goldfields. Some of the early issues that are specific to Goldfields, like a delay in its Solaris Norte project in Chile, that's now producing gold, and that's a positive in terms of the overall production profile for the likes of Goldfields. So Goldfields, some of the mines are shorter life of mines, but that will be offset either by acquisitive activity, but also by new opportunities that are coming on stream. It's one, as I mentioned, that we do like in the portfolio. It's done very well. So if you look at the current upside now, it's only at 10%. And we would look to take some profits, should Goldfields continue doing well. One stock that's been a detractor in the portfolio is Netcare. We still do like Netcare, and we've been adding Netcare to the portfolio. And it's important to highlight that the overall healthcare sector has come under pressure. Firstly, due to COVID, when during COVID, occupancy levels were very low in the healthcare sector because of the lockdowns that we've seen. But the recovery hasn't been as fast and as quick as one would have expected. So although we're seeing volume starting to increase, the recovery has been much slower, and margins have also taken longer to recover. We've seen lots of pressure in terms of overall pricing, and this is pricing pressure from the funders, effectively the likes of the medical aids, putting pressure on the hospital operators to become more efficient, to reduce pricing, so that the profitability of the medical aids are also maintained. But what we see, in terms of Netcare, it's an operator that has cleaned up its balance sheet. They've exited the UK operation. They're largely now a South African operator of acute hospitals. They've got strong market shares in the big metropolitan areas, especially in Gauteng. And what this allows them to do is to benefit from the economic growth in the big metropolitan cities. They produce a lot of cash, and that cash will be used either in terms of buying back shares or paying out higher dividends, and we've seen that continue. So we still do like Netcare. We think the overhang in terms of NHI is there, which is the National Health Insurance, and that's having a negative impact on the healthcare sector overall. Whilst we do think NHI is important, we think the form that it's currently proposed in is not sustainable and not feasible. And we would, there would be some amendments to the current form of the proposed bill. So if it does get passed, by Parliament and signed in by the President, I think you're going to see a long drawn-out process in terms of the court process trying to amend the bill. And once that is out of the way, there would be some certainty and some clarity in terms of how the overall NHI bill would look. So if it does get, if the NHI does get implemented in its current form, that would be negative, and that would be one of the key areas that we would flag as a negative for the likes of Netcare. So if you look at it from a valuation perspective, there's still attractive valuation. There's 30% upside. We think the share is trading at attractive levels at around 11 Rand 50, and our target price is 15 Rand for the likes of Netcare. So putting this all together from a macro perspective, what we see is there's different scenarios, and we've given probabilities to these three different scenarios. So in the middle there is our base case of a no landing scenario, and that's at a 60% probability. Effectively, what we see is a continuation of global growth, and as I've mentioned, is global growth, especially out of the US, has been very robust. And if that continues, and the longer that continues, inflation will stay higher for longer. And once inflation stays higher for longer, that's going to put more pressure on the Fed, and effectively interest rates in the US are also going to stay higher for longer. But in that scenario, you would see earnings grow at a modest level. Financial conditions would be quite easy, and credit that would be supported by easy credit growth. What does it mean for effectively asset markets? In that scenario, the dollar would be stronger. A stronger dollar is negative for the likes of emerging market currencies like the Rand. And equities would do well in that scenario, especially developed market equities. From a style perspective, growth and quality would outperform value, and value would be the likes of the commodity counters and some of the domestic names listed in our market. To the right is a hard landing scenario, and to that we've assigned a 30% probability. In that scenario, you get a global recession, earnings would decline, and central banks would need to cut rates. Some of the drivers would be, tight lending standards, credit that's been reined in, US unemployment starting to tick up, and China not stimulating as much. And again, that would have a very negative impact on the property sector. And why that is important is because the property sector makes up about 30% of the GDP growth out of China. What does that mean for asset markets? In a hard landing scenario, the dollar would be quite strong. Again, the same as a no landing scenario. Equities would come off. The dollar acts as a shock absorber and, effectively a flight to safety. You would see credit spreads starting to blow out. And from a style perspective, again, growth and quality would outperform value. So, putting those two scenarios together, a no landing scenario with a hard landing scenario, that's a 90% probability in our view you still want to favor growth and quality from a style perspective. To the left is a soft landing scenario. And we think this scenario playing out is a much lower probability. And this is where you have everything coming right at the same time. So global growth slows towards trend. Inflation, slowly comes down to that 2% level that the Fed is targeting. Earnings continue to grow at a modest level, and central banks start to cut rates in that scenario. What would play out from an asset market perspective is you would see the dollar weaken, which would be positive for the likes of the rand. Equities would outperform. And again, from a style perspective, this is a scenario where value would do particularly well. So you're looking at the commodity players doing very well in this scenario, the likes of the domestic names listed on our market also doing well if a no landing scenario does play out. In terms of the month ahead and what we're looking at, corporate earnings, what we're seeing now is the first quarter earnings starting to come out of the US. And so far, it's been a bit of a mixed picture. There's been a slowdown in terms of some of the corporate earnings, especially out of the consumer side. We've seen some weakness come through, and we're also starting to see companies warn of a murky picture. So last year, it was clear the consumer was doing well, although inflation was quite high. Pricing power was in the company's favor, and the companies were able to put through quite strong pricing increases, and volumes weren't getting affected that much. What we're seeing now is that although price increases have started to come through, volumes are starting to come off quite a bit. So companies are a bit more cautious now than they were 6 to 9 months ago. From a Fed perspective, we've had the latest Fed statement last night. And what was clearly evident there is that the Fed is going to be very cautious. They're going to continue on this data-dependent path, and they're not going to be in a hurry to reduce rates. I think what we're seeing now is the market starting to adjust to that scenario playing out. And, as I mentioned in the beginning, rate cuts and rate expectations out of the US have fallen from 6 rate cuts for 2024 to less than 2. And I think the longer that inflation stays higher, the longer we're going to see this scenario play out and essentially speak to a no lending economic scenario being playing out. From a South African perspective, later this month, we do have our elections taking place. And it's something that, it's difficult to forecast the outcome. What we're doing in terms of our portfolio is making sure that we positioned in the stocks that have good bottom-up fundamental value that can withstand either outcome. So if assets do get very cheap, and if assets do sell off quite significantly, that would be an opportunity for us to take advantage of attractive valuations and attractive multiples. We're building the portfolio to be, withstand different outcomes from an election perspective. And it's important that we don't pin our overall view on just one scenario. So the stocks that we have in the portfolio is essentially stocks that we think are very cheap, that we think can continue to grow earnings in this environment, and are very strong in terms of the overall balance sheet. So there's no issues in terms of capital raises, margin pressure, companies looking to cut dividends, for example. Those companies are very robust in terms of their own overall balance sheet perspective. And then global growth. Again, global growth is starting to broaden. The US is doing very well, but we're starting to see some positive signs out of Europe and out of China. So China has come out and they've said that they would continue to support the economy. Essentially, what is happening in China is that they are going through a transition phase. So the economy was very much weighted towards the corporate sector, towards the property sector, and they need to rebalance that economy so that the consumer takes up more of that slack. And we're starting to see some signs of that happening, although that's going to be a long process and it doesn't happen overnight. So some support for the property sector out of China is keeping markets at bay and alleviating some of the fears around a collapse in the economy. We've also seen a change of sentiment in terms of the language coming out of China. So that's very important for the likes of Naspers because of their shareholding in terms of Tencent. So we've seen a relaxation in terms of gaming approvals. We've seen, China supporting the manufacturing sector and supporting some of those key sectors that are important for the growth going forward. And that includes, electric vehicles, that includes green energy, high-end technology, and manufacturing. And that is something that's going to continue to happen out of China, whereby they're shifting out of this low-cost producer mindset. And that's been taken up by other parts of the world, such as India, Bangladesh, some of the Asian countries. And China is going to continue on that path. So these are some of the key factors that are quite important at this point in time. We continue to take advantage of opportunities that we see in the market as they present themselves. And I think, although there's a lot of uncertainty, there's always a lot of uncertainty in markets. We have to navigate through that uncertainty, and that allows us to find opportunities as they present themselves. So that is a rundown of the overall macro view and the bottom-up view. If there's any questions or any further interest and uptake, you've got Verlin's details up there, and please feel free to contact him at any time. Thank you.
Okay, Imti, thank you very much. That was a rather in-depth, and thank you for adding one or two technical slides into it. I think the interesting thing is to look at the heat map, the change, and just to have a bird's eye view of what works and what's not working. It does add a bit to the process, so people understand that there's actually more than just picking a stock, and that we have to have a bit of an in-depth knowledge of what the markets are doing and certain factors that are positive and negative in terms of where we can position ourselves. So just to put some clarity on it, Sentio is a style agnostic manager, and we are presenting at Meet the Managers, and we are going to talk about being style agnostic or being nimble between business cycles. And it's a term which has become very relevant, and it quite simply means if you're a style agnostic manager, and you would have heard during the presentation, Imti talks about momentum, growth, quality, value. You get different asset managers have a different type of style. So an Alan Gray would, for example, be a value manager. And depending on a market cycle, a value manager, depending on their approach, would do either well or they would not do well. Sentio tries to position on the right side of the business cycle and use a momentum or a growth or a quality growth, momentum growth, value, whatever is the most relevant to reduce the risk and to optimize return in the same swing. So that is style agnostic, and that's why we talk so freely between styles in terms of what we look at, so that we are a style agnostic manager. So I did not see any questions in the commentary box, Imti. I've just got one question for you. US inflation, and we did discuss this. US inflation seems to be a persistent thing that we look at. When do you think it would move off the radar, or is it something that's going to be part of the investment theme for the remainder of the year?
Yeah, thanks, Roland. I think that's quite an important topic, and it's something that's been a big driver of policy, especially out of the US, and that's driving monetary policy, which effectively drives monetary policy around the world. So inflation and US inflation is very important because that's the one factor that the Fed is also quite resilient about in terms of looking at how inflation comes down and what would be key for them to cutting interest rates. So we've seen a long pause in interest decision out of the US, and essentially interest rates are hovering at that 5.25% level because inflation hasn't come down to that 2% level quite yet. So I think until and unless we get to the lower 2% levels, US inflation is going to be quite important. I would add that the unemployment level is also tied to that. So if we do see unemployment starting to tick up, you would see in US inflation starting to also tick down because of some of the release valves that you're seeing out of higher unemployment. So it is a big theme. That coupled with unemployment is something that's going to be the big macro drivers, especially out of the US. And it's something that we're monitoring quite closely, both from a macro level and also from a granular level, starting to monitor what's driving inflation and unpack some of the big drivers. So if some of the big drivers are temporary, for example, one could make an assumption that that would reverse. But if you're looking at wage inflation, that's been quite persistent, and wage inflation is something that takes a long time to come back down towards normalized levels. But what we would see is if you do have unemployment ticking up, wage pressure would start to decline. And again, if oil prices start to decline, that would also bring down the overall inflation rate.
Okay, that's a great answer. Thank you, Imti. Guys, we're on the nut. 10 o'clock, 4 minutes past 10. Thank you for attending, and I think we can wrap this session up. Our next session is going to be somewhere around the middle of June, and we look forward to hosting you for another session. Thank you very much, and thank you, Imti. Much appreciated. Have a good day.
Thank you. Thank you. Bye.